For many who have transitioned from traditional employment to self-employment, the absence of automatic tax withholding can be a significant challenge. In a typical job, taxes are deducted before you ever see your paycheck. But as a self-employed individual, every dollar you earn appears in your account, indistinguishable from the next. Some of it is yours, and some of it belongs to the IRS. Without clear separation, it is easy to spend money that was never yours to begin with. This lack of distinction can lead to cash flow issues, as you might inadvertently spend funds needed for tax payments. When planning for taxes, it's crucial to understand that you owe on two fronts: self-employment tax and income tax. Self-employment tax includes Social Security and Medicare contributions, requiring you to cover both the employer and employee portions. This amounts to roughly 14.13% of your net profit, after accounting for the deductible half adjustment. Income tax, however, is more complex and varies based on your filing status, tax bracket, deductions, and other personal factors. Importantly, both taxes are calculated on your profit, not your revenue. This means you are taxed on what remains after legitimate business expenses, highlighting the importance of accurate expense tracking. Accurate expense tracking is not just administrative box ticking. It directly impacts your tax liability. Every deductible dollar you fail to record is a dollar you pay tax on unnecessarily. For instance, if you earn $90,000 in revenue but have $34,000 in expenses, your taxable income is $56,000. Proper tracking ensures you only pay taxes on what you truly owe. This is why maintaining detailed records of your business expenses is crucial, as it can significantly reduce your taxable income and ultimately save you money. A common rule of thumb is to set aside 25 to 30% of your profit for taxes. This percentage is designed to cover self-employment tax and a moderate federal tax bracket. However, it's essential to adjust this percentage based on your specific circumstances, ideally in consultation with a tax preparer. Factors such as your tax bracket, state taxes, and any withholding from a spouse's income can affect the appropriate percentage. Consistency in applying this percentage is more critical than the exact amount. Setting aside 25% each month is more effective than aiming for 32% but never following through. The key is to make this a regular practice to ensure you are prepared for tax obligations. The most effective way to manage your tax obligations is to make it a transfer, not just an intention. Open a second account and move the money the day it arrives. This habit prevents you from spending money that is not yours by removing it from your view. By transferring the funds immediately, you ensure that they are not visible when you check your balance, reducing the temptation to spend them. This proactive approach helps maintain financial discipline and ensures that you have the necessary funds available when tax payments are due. This approach works because it removes temptation. By transferring the money out of your primary account immediately, you ensure that it is not visible when you check your balance. A balance you cannot see is a balance you do not mentally spend. This simple action can prevent financial missteps during good months when your income is higher. The psychological effect of not seeing the money means you are less likely to consider it available for spending, which helps maintain the integrity of your tax set-aside. If your bank offers automatic rules, take advantage of them to automate your tax set-aside process. Automating the transfer ensures that it happens consistently, without relying on memory or discipline. If your bank does not offer this feature, establish a habit tied to income events rather than specific dates. This ensures that every time money comes in, a portion is automatically set aside for taxes, making the process seamless and reliable. By tying the transfer to the arrival of income, you create a system that is robust and less prone to human error. For those who expect to owe a significant amount, the IRS requires estimated quarterly payments. Underpaying can result in penalties, making it crucial to adhere to this requirement. Quarterly payments reinforce the importance of setting aside money regularly. If you have been moving money consistently, these payments become a straightforward transfer between accounts rather than a financial burden. The people who find quarterly payments painful are often those who have not been setting aside funds. By maintaining a consistent set-aside habit, you ensure that you have the necessary funds available when these payments are due. Maintaining visibility over your finances is crucial. You should be able to quickly answer questions about your earnings, spending, and profit at any point in the year. If these figures are readily available, you can make informed decisions and avoid surprises come tax time. Logging income and expenses as they happen allows you to calculate profit and set aside taxes efficiently. This practice ensures that you are always aware of your financial situation and can adjust your tax set-aside as needed based on actual earnings and expenses. The discipline of regularly logging your income and expenses cannot be overstated. By keeping a consistent record, you ensure that your profit is accurately calculated and your tax set-aside is appropriately applied. This habit transforms tax season into a mere formality rather than a stressful scramble. Regular logging allows you to track your financial progress and make necessary adjustments throughout the year, reducing the likelihood of unexpected tax liabilities. While these practices can guide you in managing your tax obligations, it is important to remember that none of this is tax advice. Your specific circumstances, including filing status, state, and deductions, will affect your tax situation. Consulting with a tax professional is essential to ensure accuracy and compliance. A professional can provide tailored advice based on your unique situation, helping you navigate the complexities of tax planning and preparation. Ultimately, the key takeaway is that some of the money in your account is not yours. By recognizing this and setting aside funds consistently, you can avoid financial pitfalls and ensure that you are prepared for your tax obligations. This proactive approach can safeguard your business's financial health. Understanding that a portion of your earnings is earmarked for taxes helps maintain financial stability and prevents the stress of scrambling for funds when tax payments are due. For more resources and tools to help manage your business finances, visit weaverbusinessacademy.com. Here you can find additional guidance to run your own numbers and ensure your business remains financially sound. Access to these resources can provide valuable insights and support as you navigate the complexities of financial management and tax planning.